Assalamualaikum and salam sejahtera. Welcome to ACC106 lecture series, and this video is number 3 that we discuss on the topic of accounting equations and accounting classifications. The basic elements in accounting is actually what it owns, and the second one, what it owes. What it owns actually the economic resources that owned by the organization. So these economic resources is to be used in helping the organizations generating its revenues. So in accounting, what it owns will be called as assets. Example of asset is cash or inventory. Or any other asset, for example, land and building. The debt owed by the customers, as we call account receivables, motor vehicles, futures, and equipment. What it owes, however, is the organization's resources, that is financing the economic resources. If you have, for example, land, how do you acquire the land? How you buy that land? Where the money comes from to buy the land? So if you have the money to buy the land, I mean the owner has the money to buy the land. So the business is actually owed to the owners. That is usually the main source of business, as we call it equity. That is an owner's resources that have been given to the business so that the business can buy or acquire the asset. So in sole proprietor, we call owner's equity, but in partnerships, we call partnerships capital or funds, and in a company or corporate we call shares. So those are the equity, the owner's equity, that is the business owes to the owner. And the other part, funding that business could have, is from the rise of the debt that is usually resulting from the activity of purchasing goods on credit, or you borrow money from the bank, loan borrowings. So these debts are owed to somebody else, to the third party, not to the owner, but to other people. So when we owe other people, we call as liabilities. So when the business owe to the owner, all those what it owes to, what the business owes to the owner, we will put the calculations or the informations in owner's equity. And if we owe to the business owes to other people, we will put under the terms of liabilities. So liability can be in terms of owed to the creditors, to the suppliers. So we put the in the terms of account payable. If loan, we call as loan. So the basic accounting equations, it depends on what it owes and what it owns. So what it owns is an asset, and what it owes is liabilities and equity. So the basic accounting equations is asset must be equal to liabilities at owner's equity. Usually we will see that these equations in statement of financial positions, because that statement of financial position will show what are the assets and must be equals to its liability add with owner's equity. And when it comes to the classifications, actually the classifications to identify which items to be classified of asset or liabilities or owner's equity. So assets, just now we say that assets are the economic resources that owned by the business, and these assets are expected to benefit to the business in the future. So we would have we will derive benefit from the asset we can use, or we can use it to run the business, or use it to rent out to increase the revenue. So any of the asset must have a benefit to the business in the future. Liabilities, just now we discussed, is a creditor's claim to the assets. So other people, we owe to other people, and we are obliged to pay back to these creditors or the outsiders. And owner's equity is the owner's claim to the asset, where this sometimes we calculate using the amount of asset deduct with liability, and we have the owner's equity. And normally owner's equity will include the profit that has been made by the business. Revenue, expenses, capital, and drawing. These four is actually comprises under owner's equity, but we need to understand what are these four terms all about, because we will encounter these terms again and again throughout our course. So revenues is actually items that increase our economic resources or increase the owner's equity. Sometimes through increases of asset, and sometimes the reductions of liabilities. So increase the wealth of the business. However, the expenses are decreasing the economic resources or decreasing the owner's equity, whether it's caused by outflow of using of asset, or you are incurred of liabilities from delivering or producing the goods, or sometimes the payment because you have rendering the services, or sometimes a payment that we carry out for other activity, for the normal business activity transactions. The capital is a contribution by your owner, and the drawings, whenever owner to the business asset, which is the drawing will decrease the economic resources or owner's equity. So this four will turn out later that is under the owner's equity, but normally we will separate the revenue and expenses from discussing the owner's equity. Just now we discussed the basic accounting equation is asset equals to liabilities and add with owner's equity. However, the owner's equity actually can be separated to other items, that is capital add net profit deduct drawings, and the net profit is actually derived from revenue deduct expenses. So when you have an equations that you separate the capital, revenue, expenses, and drawing inside that owner's equity, in the end, you will have the expanded accounting equation as asset at drawings at expenses must be equal to capital at liabilities at revenue. These expanded accounting equations that I arrange is much easier for you to memorize, because if you take the capital letters A, D, E, other, must be equals to C, L, R, clear, other, clear. So whenever it involves of accounting equation effects, in fact, in the trial balance also, you will see that asset drawing expenses must be on the debit side, and capital, liability, and revenue must be on the credit side. So this expanded accounting equation must be memorized, must be understood by you, so that when you do the ledgers and you do the trial balance, you always remember asset drawing expenses must be equals to capital, liability, revenue. This is another table or to memorize. This is very important, not really important, but it can helps you, assist you to understand and to make you confident on the recognizing which account to be debited and which account to be credited, and what are the effects of transactions to the accounting equations, where this is the table shows that asset drawing expenses, whenever there is an increase of asset drawing expenses, you will debit the accounts, and whenever the asset drawing expenses decrease, you will credit the account. And but the items that categorize or classify as capital, liabilities, and revenue, it will be vice versa, where this capital, liabilities, revenue, whenever they are increased, you will credit the accounts, and when they have a decrease of capital, liability, and revenues, it will debit the account. So this can be memorized by you using that that particular table. We will discuss that those tables later in the future. Okay, let's have a look on the classifications first. Remember, asset must be equals to liability at owner's equity. However, it's said there are two categories. First category, we'll look into the non-current asset, where this non-current asset, remember current asset, remember all the assets must have benefits to the business in the future. So when you want to classify the item as non-current asset, first you will identify there is a benefit to the business, and the second one is the useful life that you can use. The benefit that can be derived from this asset must be more than 1 year. So for example, the building, of course, you can use that building more than 1 year. The same goes with the furniture, because furniture has a more durables in number of years. So probably you can use the furniture more than 5 years. Another one is fixed deposit, where you save money in the bank for a stipulated time. For example, you want to put the money for 6 months, and you will not use that particular money for the 6 months, so you put in the fixed deposit. And the fixed deposit, when you put the money in the bank, you will have a return, a dividend or interest that will be arise from fixed deposit. So the dividend or the interest that you will have is benefiting the business. So fixed deposit normally, business normally put more than 12 months. So that's why fixed deposit are more likely to be classified as non-current asset. But if you take the fixed deposit for 6 months, then you need to categorize it as current asset, not non-current asset, because non-current asset has a cutting point of 1 year or 12 months. The same goes with fixtures and fittings. Fixtures is your furniture that fixed, or not really furniture, things that fixed in your building or on the wall. So it's fixed, so it's fixtures that you cannot move it. And fittings are custom made of furniture or items that you custom made that fit to your business. Intangible non-current asset has no physical substance, because non-current asset has a few subtopic or subtitles. The non-current asset, because we have tangible asset, that is something that you can touch, you can see, that has physical substance. The second one is investment, that is fixed deposit, long-term investment, or you put money somewhere more than 12 months, then it will be category as investment and must be reported under non-current asset. Another subtopic under non-current asset is intangible non-current asset. So intangible items do not have physical substance. For example, the brand. When people say McDonald's, you in your mind will have that logo, the M logo, right? Definitely your mind will see that. When people say Colgate, your mind will automatically will visualize a toothpaste. So those are brand that is to get the brand is to be well known. There are the costs that involves building up the brand. So the brand is actually benefit to the business for a long time, because McDonald's has been around around the world for a number of years, many years. So whenever you saw that M sign in anywhere, you will feel hungry, definitely. So it's benefit to the business. A trademark, usually they have more or less like a logo. So those trademark is very important for people to, whenever they see the logo or the trademark, they will know, okay, that is for this types of company. For example, the logo of Petronas. So you know, okay, that Petronas sell petrol. So of course that is the trademark. The people knows if you want to buy the petrol, you go to Petronas. Goodwill, say another intangible non-current asset. Copyrights protect the creative writings or creative development, creative what it says, other creative writing songs. So those are copyrights that have been given to the particular organizations. And whenever you want to use the items that has copyrights, you need to pay to the owner of the copyrights, so it will benefit to the owner. So if the company owns a copyright, So people will pay you, people will pay the business for using the copyright. So that is the benefit for the business. And it can be more than 12 months. And also IP rights. Nowadays, lots of using the intellectual property rights, example, patents. So patents or franchise license. So those are the items that can be in non-current asset, because those are protected items or protected value of your business. So people, if they want to use it, they have to pay to the business. So that's why it benefits to the business. So another subtopic of non-current asset is biological asset, that involves items that growing and change over the time, and the value keep on changing over the time. So however, those assets, those non-current assets are needed to be inside your financial statement, because at the end it will turn into the inventory, then you can sell off. For example, the chickens or the goats or the cows, because you need to value them over the years, because when you want to sell it off, before you sell it off, because before you turn into an inventory to sell off, you need to record them as non-current assets. So that is a measurement how to value those items, those cows and the chickens and so on. And also the plants, pokok durian or pokok kelapa sawit and so on, they need to measure what is the value of those plants, so that it will be recorded in statement of financial position as non-current asset, that you have that particular asset that will benefit to the business in the future. Okay, so those items that I have discussed is in the non-current asset. And another category of asset we call as current asset. So the current asset is actually defined as cash or asset that can be converted into cash within a year. So current asset are the cash or any other asset that can be converted into cash within a year. For example, is account receivable, the debt of customer. You usually allow your customer to delay the payment not more than 1 month. So usually you will ask the customer to pay, to turn that debt into cash within the 1 month notice. So it can be converted into cash within a year. Cash in bank, of course, you can go to the bank and cash it. The inventory, you shouldn't hold your inventory more than 12 months, because when you buy goods, items, intend to sell off, of course, you want to sell them as quickly as you can. Not waiting for the customer to come. You need to promote it and try to sell off within a year. So if you cannot sell off your inventory more than 1 year, so you shouldn't be in the business, right? Or you shouldn't sell or intend to sell that particular goods or items, because inventory should be turned into cash less than 1 year. Cash in hand, accrued revenues, and prepaid expenses. So accrued and prepaid, this one will be discussed in the later chapters. So remember, the money and inventory, those are usually we have for current asset. So liabilities, Again, just now, the same as I said, has two categories. We have non-current liabilities, where the non-current liabilities means that the definition says obligations that are expected to be fully paid more than 1 year, meaning that the time to settle off all the debt of non-current liabilities, it will take you more than 1 year. For example, a loan from the bank or any financial institutions, usually it will take you more than 1 year. Uh, However, if you take a loan from Tekun, for example, Tekun is one of funding to small businesses. So there are a loan that offered by Tekun for 6 months period, means that you need to settle off the loan within the 6 months. So if the settlement within not more than 1 year, not more than 12 months period, so you shouldn't put it under non-current liability, because non-current liability must be expected fully paid. The settlement due is actually more than 1 year. So the example is bank loan and debenture. And debenture will not cover in ACC 106. And just now I said, if the settlement, for example, the loan from the good is only for 6 months, so we should put under the current liabilities, because under current liabilities, obligations that are expected to be settled off within or less than 1 year. For example, the account payables, we owe to supplier whenever we receive the goods or items from supplier. We delay the payment. So usually supplier or vendors only allow us maximum of a month or 30 days, or sometimes they only allow you 14 days. Even though you delay the payment, you should record that there are the debts to the supplier. So those debt we call as account payables in general terms. Accrued expenses, we owe. We have used the electricity, for example, but we haven't paid it yet, so we actually owe to the TNB. So it's an accrued expenses. Bank overdraft means that you overdrawn the bank account. For simpanan, account simpanan, there is no bank overdraft. It only can be done by businesses with the current account, with the approved to have this kind of facilities. A short-term loan just now from Tekun and prepaid revenues. You overpaid your you over received the money from the third party. It's still not your money, so you owe actually to that third party, because that's not your money. Okay, we will cover the accrued and prepaid later on in the later chapters. But the current liabilities, again, always remember the cutting point is 1 year. The time or the period that you need to settle off all the debt to that third party is less or within 1 year period. Owner's equity. Previously, I already discussed the owner's equity is actually capital at net profit deduct drawings. So capital, again, reminding you, whenever owner gives something to the business, give asset to the business, either cash or any other asset, non-current asset to the business, so it will be recorded as capital. And the capital add with net profit, where the net profit is actually derived from revenues deduct with expenses. So revenues increasing the owner's equity, and expenses will decrease the owner's equity. And this net profit must be given to the owners. And deduct with drawings. So drawing is whenever owner took something from business for personal use. That must be the keyword that you should look into. Whether the owner took something for business use, or owner took something to asset for personal use. If for personal use for his home or his relatives and so on, so if personal, you must recognize it as drawings, and this drawing must be deducted from the owner's equity because it will lessen the owner's claim to the business assets. Thank you for watching. It's a very short video, but check out for the next video on the accounting equation effects, how the transaction effect to those accounting equations that I have already discussed in this video. Okay, tata for now.